I said we're going to investigate the key questions for stocks in 2026, which we've listed as such. And I think you'll agree, and we'll debate whether we've missed some of them or there are more pressing questions too. Can the AI trade get beyond the bubble banter? That's number one. Is the broadening trend durable? Right? That's what we're hearing a lot about. And can the rally run without rate cuts? Critical questions, Joe. Are those the three most pressing questions? Did we leave something out?
No, I think we have all three of them. I think the most important one is the broadening trend durable? To me, that is most important. If you think about coming into the fourth quarter, a quarter in which the S&P is 3% higher, I don't think very many people expected that healthcare would be up 11% and outperform the other 10 major S&P sectors by 8%. So I think what has happened is the personality of this market, it's becoming more discerning. It's becoming more discerning from the standpoint looking into 2026 and realizing there probably might be more rental opportunities than long-term anchoring in one particular investment theme. I think the market's going to rotate to a lot of different places, and that implies you're going to need, Scott, the 493 to participate. You cannot just rely on 7 individual stocks. You cannot rely on the AI halo to really lead the market higher. So I think that's what's going to be most critical for us. Real quick on AI, I think the market's doing a really good job in its behavior of recognizing when valuation, positioning, and sentiment gets to an extreme as it relates to that AI halo and correcting that. And I think we just witnessed that over the last 10 days.
I mean, you're almost back at 6,900. Liz, the tail of the tape, if you want to call it that, looks like this for 2025 for the majors. It's been a good year, obviously. S&P up 17%, we'll call it that. Dow good for about 13.5. NASDAQ 21.5 speaks to what has driven this market from the outset. And then the Russell 2000 has done quite well, 15%. To the upside there. Liz, what about the questions that we ask? Are those the most important for investors to consider when they think about what stocks can do in the new year?
I think they are the most important. Joe covered the broadening trend, and I would agree with a lot of what he said, so I'll take a couple of the other ones. Can the AI trade get beyond the bubble banter? I think the fact that we're all worried about the bubble banter, the bad thing rarely happens when we're all talking about it happening. So I think it can get beyond the bubble banter. The one thing that I would sort of counteract to Joe's point is that I think we do need the AI enthusiasm for 2026 to actually look good. We do need the AI enthusiasm for the broadening out trade to remain because it's so important to sentiment. And that broadening out trade, in my opinion, relies a lot on the idea that AI will start to have productivity gains in other sectors. Other places in the economy will benefit from it. And CapEx can continue not just in AI, but just generally because the economy is durable and because productivity and growth are expected to reaccelerate in 2026. So we need it for sentiment. We need it for investor sentiment and economic sentiment. But I agree that it may not be the leader in the clubhouse as far as returns go next year.
That sounds right to me. What do you think?
Well, I think, first of all, I think one of the most important questions you didn't mention, who's going to be the next Fed chair and what's going to happen at that first meeting. Because economic policy is what ultimately controls the market.
Well, it's inherent in can the rally run without rate cuts? I mean, because whoever the next chair is going to be perceived to have a cutting bias. Like, you don't have to be a rocket scientist to figure that out.
No, that's absolutely true. He's made that clear. But it's going to be, will the market, after that first Fed meeting, if there is a press conference, we don't know if they'll continue to follow that, will the market have confidence in that person? So that's going to be a critical question. We got till mid-year. Even when they name, we know who they're going to name. Market said, okay, we like all 4. We're okay. Going back to your question, look, AI, it doesn't have to continue, to Liz's point, with what we saw in the first 9 months of the year, first 8 months, but it's still got to be a relevant trade to the upside. Because if it's not, it's still a very large portion of the indices, and it's still very important, that will bring down the whole market.
Liz's point is like it's only a big part of the indices, it's a big part of the economy, it's a big part of the narrative, it's a big part of sentiment, it's kind of the biggest part of everything.
But there's a difference between the market and the economy, and they're not always reflecting one another. So my view is it will continue to be a big part of the economy, whether it's part of the market or not. I think it will be. I think the AI trade is going to continue. I think there are more landmines, frankly, on the private side than in the public side. But OpenAI, even though it's a private company, it's sort of is regarded as a public company. So if they have major issues, which is a possibility, then I think you'd see the AI trade collapse. But the base case, my base case is you still want to be in those stocks in the Mag 7.
So, Josh, we laid the questions out as we see them. We gave you the tail of the tape on where we enter 26. UBS says equities have further room to rally, and they list the obvious reasons. The current environment of solid economic growth, healthy corporate earnings, lower interest rates, and structural innovation drivers means investors can still add exposure to equity markets. So let's get your opinion here.
Well, I think we already have the answers to both questions. And I think this year has really revealed a lot about these huge misconceptions people have about how the stock market actually works. In the first half of the year, all the bears, even like the newsletter writers, the podcasters, people who don't actually manage money, the talkers, the big thing that they told us all, they warned us, they pounded the table, if anything happens to these AI stocks, you're all dead. Remember? That was the thing. Well, none of these AI stocks look good going into year end, and the stock market looks amazing. So I think we already have the answer to that broadening question. We already know that the market has broadened out and is not reliant. And just don't take my word for it. Looking at the 20 largest companies in the XLK, that's S&P 500 Tech, use that as your proxy for the AI trade, Judge. The median percentage of those 20 largest companies below their individual 52-week highs is negative 14%. So almost all of them are verging on a correction / bear market. NVIDIA's in a 15% drawdown from its high. Microsoft 13, Broadcom 18, Oracle, we know, much worse.
Amazon 12.
So
yeah,
I think we already have that answer.
Points well taken.
Well, here's the second point. I don't care which Kevin is the Fed chair. What I care is that earnings are going to be growing next year, in large part because of the benefits of AI, and also these corporations, mid-cap, large-cap, mega-cap, have just gotten really good at finding new ways to improve profitability, and we're going to see profit margins higher next year, according to Wall Street's expectations, from 13 and change percent up to like 15 and change percent. I think the use of AI is part of that story. But look, if we can do $315 in earnings per share next year, and we're at a 21 times multiple of that, I think there's still room for the market to have another good year next year. So what matters? Does the AI trade broaden out? Well, it already has. And will earnings deliver next year? Yeah, I think they will.
Is it that simple?
Well, I think it is, and I think you have to look at just today. Look at the 52-week high list in the S&P 500. I think there's nearly 30 of them. But it's Citi, it's Freeport-McMoran, it's C.H. Robinson, it's GM, it's Marriott. Yes, you have your Lam Research there. So it is about the broadening out, and I think that's the most important theme from an investment perspective that we carry into 2026, and the ability to kind of maintain that. As it relates to the Federal Reserve, look, I think it's built into the market already that you're going to maybe get one rate cut, maybe another rate cut thereafter. But I don't think the market's reliant in the second half of the year on further rate cuts. And in fact, if you're cutting rates in the second half of 2026, we have some sort of problem in the economy. So I think Josh is right to highlight the earnings growth, because we're coming off 4 consecutive quarters of double-digit earnings growth. And the expectation is that you're going to see that again as you move into 26. Now, is that expectation maybe a little bit too generous and a little bit too aggressive? Potentially. But seeing strong earnings growth is going to lead you into the direction of saying, okay, I have a variety of different places that I can allocate capital, and that's a healthier environment than where we were just 9 months ago, where we're just thinking about 7 stocks in an AI halo.